Hi. Thank you so much, Maria, for the quick intro. Hi, Gerard. Hi, Avi.
Hello.
So good to be here with you and just we are users at Capchase of both G2 and Travel Perks. So we've always admired you from a distance. So very excited to be here now. So yeah, before we jump into a meaty topic, could you just give a brief intro about yourselves and your track record so far? If you want to start, Avi.
Yeah, sure, I can start. Can you hear me well?
Mm-hmm.
Yeah, apologies for the background. I just realized that because I'm in Barcelona, it's too sunny, so it makes so video call difficult. Somebody needs to be here, okay? So don't be jealous, but somebody needs to be in Barcelona. So I'm the CEO and one of the co-founders of TravelPerk. We are the leading and the fastest growing business travel platform, and we focus on the SME market or mid-market, as defined by companies that have up to 3,000 employees. So these are not very small companies, but not huge corporate. We started a company in 2015 out of Barcelona, but now we have over 600 people in the team across different geographies like Spain, the UK, US, Germany, and the Philippines. And so far we have raised a bit less than $300 million for the company. We went through a pretty interesting 18 months, I'm sure, like many other businesses, but being in business travel was I guess even more challenging. Having said that, we are getting out of this crisis. We are back to hyper growth in revenue. This month we're growing 4x on pre-COVID numbers already in revenue, and this allowed us to actually raise a great round and up round during the pandemic. So yeah, a lot of stuff to talk about, and I'm very happy to be in this panel today.
Amazing, thank you.
Yeah, no, thanks. Good. For having me here, Miguel. And but I'm Godard Abel, co-founder, CEO of G2. Yes, that's our beautiful logo. And but G2, we're aiming to build the place you go for software anywhere in the world, whether you're in Barcelona, New York, India, Japan. Because I think software is a very global market, and we want to help business software buyers around the world discover the best apps. And really, our inspiration for starting G2 way back in 2012 was I've been a software entrepreneur for a long time. Over 20 years now. I just thought it was way too hard to discover and buy business apps. And we also thought there was no good place to get peer insights. And the status quo of our industry was analysts like Gartner. And I think they're good for some enterprise CIOs, but the reality is software is being consumerized. And now you have marketers, finance people, salespeople, all buying their own apps. And I think a startup like G2, we have 200 apps. And frankly, I don't even know what most of them are because our teams are just buying apps that make their lives better, make them more productive. And so G2, we're really all about building that place you go for software. And we also help about 2,500 software vendors now reach our growing audience, about 7 million business software buyers a month. But it's also a great place for software vendors that have great reviews to then also market and drive more growth.
Amazing.
And capital raising, I think that's the topic of this panel. But we've raised $257 million. And became a unicorn earlier this year. So we have done a Series D. And I did also start 2 prior companies. First one, Big Machines, bought by Oracle. There we also raised, well over 100 million. And then we started SteelBrick, which was bought by Salesforce, 70 million raised there. So I have a lot of experience about the good and bad about raising money.
Exactly. We're just going to jump into that topic. So thanks for introducing it. So I think that Avi and Gerard, both of you have started several companies, from scratch. So it would be great, to hear, how your fundraising experience looked like, from the early stages in a company or 2 companies ago, and then how that has evolved to the current present.
Yeah, I'm happy to start. So this is TravelPerk is actually my second startup, as you correctly say. The previous one, Hotel Ninjas, was a bootstrap business. So I'm not sure it's that interesting for a fundraising panel, or maybe it is actually, but we couldn't raise. So we just, many people would claim that they would bootstrap because they're smart. We just couldn't raise. The business an easy one to pitch, and we bootstrapped and we ended up selling that business to Booking.com in 2014. And TravelPerk is a very different journey. As I mentioned, we raised close to $300 million so far. The last round was a $160 million round that we did around March, April of this year. Yeah, happy to answer any question about the funding. But we have investors on the cap table. We have investors such as, I hope I will not forget anybody, DST, Chinovik, Target Global, Fix Capital, Hardcore, Spark out of Boston, Local Globe, Latitude, Amplo, 14W. So it's a long cap table by now.
Amazing.
So great people.
Before we jump into Gerard and G2 and his previous journey, like, could you explain, how the fundraising, like you went from being bootstrapped in the previous company, then you worked at Booking for a little bit, and then you launched TravelPerk. So what was all the thinking behind fundraising, at TravelPerk, and why have you continued to do so as you grow?
Yeah, so it's an interesting question. I think there are probably two approaches to fundraising and or two big kind of philosophies, I would say. And underneath, you have different approaches. One philosophy, would say raise when you have a specific project in mind, and then the use of funds is kind of probably the most important slide in your deck because you're raising for a specific need, runway, or some kind of acceleration. And the other approach is to build always to have business goals rather than fundraising goals, and then to fundraise whenever the timing is right in terms of kind of the dynamics of the market, and that's actually my approach. So we always raise. Actually, we never raise when we need it. We raise when we can, and we just focus on the business, right? So that's our strategy. We always are happy to talk with investors on a kind of a regular basis, and then so investors know us and they know what we're doing and they know what we're about to be business milestone, and then some of these conversations just kind of accelerate into a full round. I have in mind especially something like our Series C, which was led by Akhil Chenwala at Chinovik, and this was an introduction from one of our previous investors. Akhil and I met a few times and had great discussions about the future of TravelPerk, and we end up doing a round. It's a very efficient way of raising because I never waste time or invest time into kind of a full roadshow, and kind of I never spend like 2-3 months of a given year on fundraising. It's always kind of in the back burner, and kind of probably 5-10% of my time is dedicated to this. It might be less efficient when it gets to valuation optimization because I have, by definition, less of a competition in every round, just because of the nature of how the rounds kind of emerge. So I guess pros and cons for every method, the one that works. And I think you should choose the method that works really well for your personality and kind of your risk appetite, and do you enjoy the game of fundraising or not? I don't, right? So I just and I'm not saying you should also only do things you enjoy, but if you can still raise and not waste too much time on it, that's my preferred approach. So I really like to build. I'm a developer, so I like building stuff. I like to these days my product is my team. So thinking about my product, the team, and kind of thinking about the product strategy as in TravelPerk product strategy, I prefer to invest my time there and less in fundraising. So which again, like pros and cons, but that's the approach that works well for me and for TravelPerk.
Amazing. Yeah. So we've talked with thousands of founders, and I don't think that anybody says like, oh yeah, I love fundraising. it's always like this bittersweet moment where you raise a big round, it's in the news, but then like you have just sold a part of the company, and that never feels that amazing. So yeah, thank you so much for sharing. Yeah. And Gerard, how about you? I mean, third company, you raised a ton of money in all of them. So how, like, why do you decide to do that, and how has that affected growth and the companies?
Yeah, and I think now at G2 I have done it more like Avi, but I think it's also part of the luxury of having it be a third company. And I think the fundraising markets right now are, if you can raise money, you can almost raise infinite amounts, and it's pretty easy to raise. But I do some angel investing, and I help some of what I call my entrepreneurial family. So team members that have worked with me at prior companies that are now building their own companies. And frankly, I see for a lot of early stage entrepreneurs, it's still hard and to raise that first round, because if you don't have a track record or you don't yet have great metrics, I think it's still really hard to break through the noise. And actually my experience, my first company, and I started way back in end of 1999, beginning of 2000. Most of you are probably too young to remember that, but that was the first .com era. And the markets were very frothy. So I was actually able to raise $20 million for my first startup Big Machines, like within the first year. And frankly, I had very little metrics. I just kind of had this smart young team. And frankly, in hindsight, we didn't know what we were doing. I was like 27 years old and full of adrenaline, but no experience. And then we actually hit a really hard time, because it was like 9/11 happened in the US, and there was a big recession, and there was a .com crash. And frankly, there were a couple of years there where no investors wanted to invest in internet startups anymore, and we were way too early. And then we had to go into bootstrap mode. And frankly, for like 5, 6, 7 years, I couldn't raise money. I had to let go of we'd scaled up to 70 people based on funding, and realized I can't raise more money. I had to scale down to 20, so super painful. And for a few years, we couldn't raise money. So we were an early cloud SaaS company, you'd call today. Back then, it was like on-demand software. And so I've seen the other side of it. And so we had to bootstrap for a few years. And that actually made us, think, better entrepreneurs, but it was really hard. But it made us build a better business. And so I think it's very different for second, third-time entrepreneurs. It can be a lot easier. And for a first-time entrepreneur, I think it's a hard balance, right? Because obviously, if you can raise money that can accelerate you, it's great. But I think some people also then end up spending too much time on it. Because I think, like Avi said, I also prefer to spend 95% of my time on the team and the business. And if you can raise money quickly, you have the luxury to do it. But as a first-time founder, that's a hard balance, because you need enough money. And I'm not sure there's any easy answers, how to do it the first time.
Yeah. So in your first company, you raised some money, and then the market changed, and then you had to bootstrap, right? So that was almost like you had to react to the market changing. But now, for the audience, like, what kind of mistakes would you, tell people to avoid when they're thinking about fundraising?
Well, one, and I think most people already know this, but it's a different game than selling to customers. And I love selling to customers, frankly, but you want to just be as enthusiastic as possible. And I think fundraising has this weird dynamic. I think a lot of people say it is like dating, because investors, they somewhat, want to be mistreated, and they want you more, so it's a weird game, and you have to play different psychology and, give them enough love, but not too much love. And so it's just, kind of a different game that, you have to learn. And I think it's a hard emotional game, because all the investors also, they pretend to kind of like you enough. They're kind of doing the same thing. They're like, oh, sounds great. Let's keep in touch, but really they're thinking, I don't like it. And, maybe if your metrics turn magical in 6 months and I totally missed it, then let's talk. But, but it's a bit of a inauthentic game, I would say. And so it's hard to read and a hard game to learn, I think, as a first-time founder.
Yeah. And yeah, absolutely. Like we are first-time founders as well, so we have learned a little bit, over this last few months as we have, raised money from different sources. But it's true that there's a lot of asymmetry of information, right? And it's not about what but what you appear to know, and what they know and what they appear to know. So yeah, as founders, you just have to think that investors are probably seeing everybody in the space that you're playing, and they just measuring, one against another. And if there's something that that they don't know, like, that is a huge opportunity to get a better price.
I think just to build up on what Godard is saying, I think there are two important pieces of advice that he gave that I would like just to repeat, because I hope everybody took note. The one is you never, and Godard, please jump in if I paraphrase you incorrectly, but the first point of you never get a clear, or you rarely get a clear no, right? You rarely get somebody who says, not for us, thank you, bye, right? One, it would be silly for them not to keep contact for the future, and and two, it doesn't cost anything to be kind of nice always, right? So and what you need to do is to train yourself to identify the signals of a no, and just kind of don't lie to yourself that it's that it's not real no, it's maybe, right? Or maybe if only I did, right? So going back to the dating game, right? If I've been with the same woman for 17 years and I'm only 30, I'm kidding, I'm a bit older, but so I kind of forgot how dating is. I think you have apps now, whatever. But if I'm not mistaken, that the other person is into you if they cannot stop reaching out to you, and if you cannot, and you're into them if you cannot stop thinking about reaching out to them or even doing so. And it's exactly the same in the VC dating or in the investment dating. That it's a warm lead if they keep contacting you, asking questions, wanting to meet, speaking to maybe ex-employees or current employees or other investors, right? So, they are proactively chasing you, and that's how it feels. If they're not doing it, if you need to chase them, maybe the first time it's like, they're busy, but investors are not busy for deals that they are really interested in. So if you have to chase them more than like once or twice, just don't waste your time and theirs by trying to make it happen. And I think it's much better to cut down the losses, understand that this is not going to happen with this fund or this investor, and move on. And it might happen in the future in another round or when you hit another milestone, but it's not going to happen right now if you have to chase them. So identify the right signals and don't waste time on this. You can improve your chances on not getting the wrong signals or not wasting your time if you do the research and know that you're talking to the right investor who invests in your industry, in your stage, in your geography, who has a fund and money available. Nobody admits that they have no money available, but many of them don't. So just do the research and understand who you're talking to. I don't think spray and pray is the right strategy for reaching out to investors. And then the second point, I'll do it quickly. I know you have more questions, Miguel, but that's also important is cold emails and reaching out directly to the investor rarely works. There's so much noise in the market. I'm doing angel investments as well, and Godred mentioned that he does. You do as well, and you see how many great companies and great founders are reaching out. So there's a lot of money in the market, but also a lot of great companies or seemingly great companies, and you need to help the investors cut through this noise, and you can help them do it by asking a trusted third party. For example, another portfolio founder is one of the best ways to get into contact with an investor. So you find a person who they invested in the current company or previous fund, and then get introduction through them. Once you do the research, also find the right way of getting there, and maybe you can turn one of these other founders into your mentor to help you, especially if you never raised, to help you understand the signals, understand how to communicate with them. It's not that complicated, but it requires some experience, and you can get to the experience by having good mentors around you.
Yeah, amazing. One quick question: you both have mentioned that raising equity can be expensive, especially if you don't make it a super competitive process and so on. So how you define the cost of equity, the cost of raising a round?
So the way I would define it is dilution, right? And in other terms. So raising most of the rounds, unless it's a very competitive round, are kind of standard dilution that you're getting, and you just need to factor that in. I haven't seen recently any kind of weird terms like maybe Godred has seen in the first company, like crazy liquidation preference or ratchets or whatever. So I don't see this anymore for good companies. You get really plain vanilla term sheets at the moment in Europe and in the US. So yeah, I mean, for me, it kind of boils down to dilution. And the main point, and the most important point, who's the partner? Who's the partner from the fund that is going to join your board or observer or just the cap table? Because this is a 10-year minimum. If things go well, this is a 10-year partnership with that person, and you have no legal way of inviting them out, right? So if something that doesn't go well, if you think about it, it's higher, it's more commitment that you personally take with this partner from the fund than you do if you get married, right? Because a marriage has a legal exit clause called divorce, and fundraising doesn't, right? You cannot invite them to leave the cap table. You can buy them out if they want to, but they're not obligated to do so. So I would be really careful and thoughtful in how I understand who's this partner, who's this person that is going to join the round, and maybe their board, because this is even more important, I would argue, than dilution.
Yeah. And all right, so Gerard, just to hand it over a little bit to you, we've talked about equity fundraising, and now like is when we see like more and more founders considering things that are not just equity. So what are your thoughts about diversifying your capital structure with something that's not equity?
Yeah, and I do think I've looked at it's a good way to enhance it. So every financing we do, we normally work with SVB, but we do also always grow our debt lines at least. And I think it's pretty easy now when you're raising equity, whether it's SVB or other banks. Many people are willing to give you, and I think now we have, I don't know, like 30 million of just kind of standby lines for a rainy day, or if you want to do an M&A deal. And so I do like enhancing equity with debt because it's available, and why not? And you actually don't have to call it down. So I like having it, if you want to make bigger strategic moves or just for a rainy day, to have that available. And I do also think it can be, now there's a lot of, founders that can't raise equity because they don't have the track record or their metrics aren't great enough. There's a lot of these SaaS lending companies now. And I think it'd be a good strategy. If you kind of are going bootstrap, but you want a little bit of capital to accelerate marketing, more sales hires, I think it's a nice alternative now, where you can get, I don't know, sometimes you get like 1x ARR or, but you get some pretty significant debt just based on your revenue run rate. And I think if you're going more bootstrap, I think it's gonna be a good model to kind of get you to the scale, where you can raise equity, or some people frankly then just bootstrap and go to an exit. That can also be great as a founder. If you never taken any equity, zero dilution, and you grow it to 5-10 million ARR, you sell it for $100 million. I mean, for a founder, that's pretty amazing. Although the VCs would scoff at it, right? But I think for a lot of businesses, that can actually be a better path.
Yeah. So I mean, we that was our initial product. When companies that have recurring revenues, instead of having to wait for them to come through, they can just pull them forward and invest them into growth, right? So with the goal of not having to use VC money as much. And what we saw, is that on the one hand, second-time founders, third-time founders are more prone to using alternatives to VC. And then, about around the use of cash, I think you mentioned that every time you raise a round, you raise some more debt, and you keep it there for a rainy day or for M&A, right? So actually, Abby, you've done a lot of M&A at TravelPerk, right? So could you share a little bit more, when you raise money, if you consider anything that's not VC, and if you do, how do you differentiate what to use VC money and what to use other types of money?
Yeah, so we actually have three main sources of funding. If you think about TravelPerk, one is obviously equity, or VC money, we call it. So, and which is what we always raise from the angel round, including investing our own money at the beginning, to the Series D, which we did this year, and we're using that for just growth, right? So hiring people mostly, building the product, marketing, sales, etc. So that's the main use of equity fundraise for us. We also have two types of credit lines or debts, right? So one is a credit line, which is super useful for working capital. And I don't want to get into kind of the details, right? It's kind of boring, not because I have anything to hide, but just like a finance in a finance panel, we can go deeper into that. But I think it's a great way to fund working capital, and you get great interest rates at the moment. Who knows, if it will continue, but that's how it is at the moment. It has been like this for a while now. So credit lines are a great way to fund working capital. I wouldn't fund working capital with equity. It's more expensive in my view, and kind of just historically speaking. And then the third point is what Godard is mentioning, venture debt or some kind of, they do with SVB. We raised from Baupost in our last round to do an M&A. And if we have a specific project in mind, like an acquisition of a given company, and we can present that company as a part of that debt deal, you get, nothing is free in life, but it's as close to free money as you can think, right? Because if you buy a profitable business, which we did, and we pay back the debt, we can service the debt with EBITDA, basically from that business unit, and for all matters, this is almost like free money. So I would definitely look, if you have an M&A, for example, a project in mind and it's well baked, we try to take the idea of an M&A to to debt providers, and it didn't fly. So they really wanted to look at the actual company we're going to buy. And once we had the company with a few companies identified, we took them to the debt provider, and then it was a really easy process. It's almost automatic. I think I spoke with the debt provider like once, and then we got a term sheet for, you know, $3-digit million, right? So this was like really smooth process, and it's almost standardized and kind of factory line kind of process, unlike fundraising from a VC, which is a bit more bespoke.
And we've seen here that first-time founders are very focused on raising VC, and then like alternatives start to come up, you know, when they're thinking of the second venture, and when there's the second venture. Why do you think, you know, the second-time founders are more prone to using something else besides VC?
Well, I would say one other thing that I've always done is use your own money.
Yeah.
Because if you've had a good exit, and frankly, at the beginning when I started G2, most VCs early days didn't really love the idea. Mm-hmm. And because it wasn't, I built SaaS companies and they know SaaS. And frankly, at the beginning of G2, I didn't even know how I was going to make money.
Yeah.
And I think that's one thing if you have conviction. And frankly, I love that. But the first $2 million in G2 was really our own money, myself and a couple of my co-founders were my first venture. So we were lucky we had a good exit. And frankly, then you also own a lot more of the company. So, you know, you have more control. So, and frankly, I see some time founders not do as much of that. And frankly, to me, that's kind of a miss, you know, because like it really shows conviction, and frankly makes it super easy to raise money. Because if you're like, hey, I'm putting in my own money and you can ride along, like if people see you taking the risk, then yeah, it makes it really easy for others and you can raise money under better terms. So that's one thing I think for second, third time founders is, you know, lucky and a great thing to do, I think.
Yeah. And you know, like we have only a couple of minutes left, but you know, we talked about VC extensively, and then right now we're talking about alternative financing and why, you know, second-time founders are thinking more about it. When you're thinking about raising alternative financing, debt or whatever, like what factors should people in the audience be mindful about? So you mentioned the time, but what else? What other terms?
Yeah, I mean, let me just say something quick. I mean, one danger, I think some of these like ARR financing, you know, they then have big warrants and equity conversion. And so it may seem cheap, but I think it's something to be careful about, you know, that you don't inadvertently give away a lot of equity, you know, when you think you're just doing debt. So I think that's one thing to be mindful of.
100%.
Yeah, for sure. And by the way, like, you know, don't be ashamed, like I was, to admit that you don't know what these things are, right? Because you raise like, you look at like a term sheet of a normal VC, like a Series A, and everything is almost everything is straightforward, or you can Google it and find. And then you see a term sheet of a debt round, and you have stuff like warrants and you know and like to me it took a while to kind of be able to admit I don't understand this term sheet. Like I need to like, you know, an actual, you know, lawyer or banker to explain to me what it means and how exactly this mechanism works. And then you realize that it could be extremely dilutive if one or two or three conditions kind of meet. So yeah, I fully agree, but also be careful of the downsides protection. You know, you could be hit very severely on the downside protection, and just make sure that, you know, we founders always, you know, have optimism. It comes with the DNA, I guess. But you know, ask a pessimist person to tell you what could go wrong, and then apply that scenario on the term sheet you see, because what you don't want to do is have like a bad quarter and then lose, you know, half the company or something.
Yeah, and just one other thought I just had. I think if you can get an entrepreneur like Avi, you know, who's done it before, to invest early, I do think, you know, having some couple angels on your side that are entrepreneurs that have played the game before, I think that's just tremendously helpful.
Thanks for the plug. I actually invest. I'll be happy to get inbound. If somebody wants to raise for the angel round, reach out to me. avi@trowerpack.com.
Right. And I also think proven entrepreneurs are great investors, because frankly, also we're in a position sometimes we honestly genuinely don't care if we lose the money, you know, but we like helping, and then we can help you play the game. So, and I think there are so many now entrepreneurs that had successful exits that like investing. I would highly encourage you to get one of those in early, ideally before the VCs, because they can really be your friend and help you play this game a lot better.
Great lessons. Thank you so much, Avia and Godard. Like it's a privilege chatting with you about fundraising and different strategies. So thanks so much for sharing your thoughts with the audience. I'll hand it over back to Avia to introduce the last speaker. Thank you.
Thank you, Godard and Avia. That was incredibly insightful. What I really loved about what you said is have business goals and not fundraising goals. And if you focus on your business and that's going well, capital should flow in. But if you're a first-time founder and that's being hard, focus on bootstrapping and making your business stronger, and that can take you very far. So at the same time, founders have a lot of different financing sources today. And if traditional fundraising is not going the way that you expected, there are many different sources that you can tap for capital. So thank you so much for your time, and hope to stay in touch.
Thank you.
Thank you so much.